Are you here to improve your investment strategies? Are you looking for that one article that could help you finalize that decision you were holding off? Well then, get ready to learn more and gain just that subtle extra knowledge to get an edge in the investment business. Because if you're new here, then you've come to the right place. Welcome to the Daily Fortune, a channel where we talk about all the latest news, updates, guides, and strategies related to investment. Of course, with that said, we're going to be discussing a lot about the Oracle of Omaha, Warren Buffett, The Big Short, Michael Burry, the money tree Cathie Woods, Tesla's very own CEO and eccentric billionaire Elon Musk, along with the rest of the big leagues to learn just a bit more from the professionals. And don't worry, of course we talk about crypto, and we also talk about the best stocks to invest in, along with many tips and tricks on how to handle your finances so you never lose. So before we talk about making money, remember to hit that like button, subscribe, and ring that notification bell as well to make sure you won't miss a single video. Now let's get started. The disappearance of Michael Burry, a well-known American investor and hedge fund manager, has confused many people. Burry left clues and warnings about impending out-of-control inflation before disappearing from Twitter in mid-March. The popular predictions is that valuations of the financial markets may be about to crash. It wasn't until his catastrophic warnings about impending hyperinflation that he highlighted that the stock market was dancing on a knife's edge, and slammed stock trading program Robinhood as a deadly casino. At that point, the officials became concerned. According to multiple sources, Burry was contacted by the Securities and Exchange Commission authorities who warned him about his Twitter activity and how it could be affecting the markets. His tweets before disappearing from the Twitter world are intriguing. They may provide insight into a person who is an expert and well known for correctly anticipating major financial downturns. But then he did remove his profile after the tweets caused him to have trouble with some investors. Now let's take a closer look at these tweets from Burry, which indicate a disturbing fact about America's future and its economy. The story starts on February 20, 2021, with a tweet linking to a book called The Dying of Money, in which Burry states that the US government is driving inflation with their new irrational monetary strategy. The pandemic's unexpected impact prompted the US Federal Reserve to go on a printing spree, printing more money in the last 13 months with 3 stimulus checks already distributed to average Americans and a 4th on the way. The ramifications of printing money are starting to be felt. This, combined with weak demand and a rising debt to GDP ratio, resulted in an unbalanced American economy. If you dig deep enough and know your history, it's clear that it has bad effects on every aspect. What we're actually witnessing now indicates a severe inflation problem, though the administration says that it's under 2%. It's quite hilarious how they deny it and make people believe that it's just normal, but the effects are very obvious. Petroleum, vehicles, housing, goods, and other products and items have all been seen to have an increase in price. And you've all seen the big price increases over the last year. While the Fed chair states that it's only temporary, repeatedly saying these words over and over to all listeners. How much inflation is the Fed willing to tolerate before intervening to keep pressure on prices under control? When it comes to inflation, Powell indicated that there are a few aspects. One is that they track inflation over a 12-month period, and as they get past the extremely low inflation readings of March and April of last year, measured 12-month inflation will rise a few tenths. This is known as base effects, and it is a short-term occurrence that they believe will pass eventually. There are possibilities and some estimates that imply that once the economy is fully operational again, there may be a spike in spending as people are relieved that the pandemic is over. After the long lockdown period, people are more eager to go out and spend time outside. Right now, this could put upward pressure on inflation. They consider that to be something that is likely to be temporary and not very significant. In both cases, they don't consider those to be particularly huge or lasting. The Fed chair will be forced to acknowledge and admit inflation and its consequences. The second tweet of Michael Burry is a tweet that serves as a reminder that inflation does not occur all at once. In Germany, it lasted 9 years, with the final year resulting in a complete collapse. In this graph that you can see here, it provides the context for that tweet. This was the value of the 1 ounce of gold in relation to 1 German mark from 1918 to 1923. The German mark has been vulnerable to high inflation for years. Because this graph is in log scale, the right y-axis will not move up in even numbers. Instead, it will increase exponentially. The German mark had depreciated to the point where it could be used as toilet paper by 1923. It may be funny, but it's all true. Remember that the buildup lasted a year. While 1923 may seem like a long time ago, the United States is not exempt to this circumstance, as odd as it may appear. Hyperinflation is widely known as the most prevalent means of bringing a country down. Based on last year's events, we've built the basis. To bring it down, all that's required now is a catalyst. And what could that catalyst be? What are some possible inflation hedging strategies? Burry is fully aware that the current phase of monetary policy is driving money into the stock markets. He wrote his farewell tweet on February 21st, noting that professional investing teams are gradually taking larger and larger risks by being more innovative in order to create highly leveraged positions. It was almost as if he knew what was going to happen because this emerging narrative is causing ripple effects throughout the markets, which we're seeing. The fall of Archegos Capital Management, which is a family firm with significant investments in media corporations and Chinese internet brands, made the headlines. Bill Wang, the founder of Archegos, which was established as a family business after his own was shut, was a part of Tiger Asia and was forced to liquidate more than $20 billion in equities. He had lost a significant amount of money due to the fall of the Archegos. He pleaded guilty to wire fraud on behalf of Tiger Asia in 2012, and it all came crashing down late when Goldman Sachs, which had previously declined to deal with Bill Wang due to those insider trading allegations, pushed him to sell some of the stocks he had leveraged long in a big way, particularly technology stocks like Baidu and Viacom. So Viacom was affected severely because it issued stock throughout the week. 1 month later, Archegos Capital had disintegrated in the midst of a bull market, in which prices are rising or are expected to rise. Archegos managed approximately $10 billion in the capital, and some sources said that losses might have surpassed $50 billion due to excessive leverage. You can immediately realize that this situation was caused by complexities in finance. Bill Wang was the biggest loser among all of the investors.
Loser! You're a loser! Are you feeling sorry for yourself?
Because its positions were derivatives rather than actual stocks, Archegos was able to build massive investments. Without having to register their holdings to regulators, some of them were granted access to more than 10% of these firms' stock. With conventional stock investments of that size, they would have had to do something comparable. This enabled Archegos to keep its stock exposure disguised until the agreements were completed. Archegos' fall is another reminder of how much debt has been accumulated during this market mania, and also how sensitive investment banks have become. What will happen if the economy is performing well and huge investment banks are losing billions of dollars and going bankrupt? The story of Archegos was buried immediately, but it is a great lesson and an event that deserves more investigation. Imagine what lies behind, waiting to crash the entire market when things go wrong if a skilled investing team can lose $50 billion during a huge bull market. Massive derivative positions are being built right now, and the catalyst I mentioned before is right in front of us, and we should do something about it. And there you have it. You can leave a comment in the comment section below. Thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.